So in this video, we will look at how we can make adjustments for intangible assets. And specifically, what we will look at is adjustments related to R&D, but a similar reasoning and also a similar methodology applies to other types of intangible asset investments, like SG&A and advertising. So why do we do this? It's not the case that all companies have investments in R&D, but if we look at the companies that do invest in R&D, it's a really major component. So if we look at all firms in Compustat that have investments in R&D, their outlays are equal to 12.5% of assets and 75% of sales. And there are actually companies for which R&D expenses are greater than sales. So not all companies have R&D, but for the ones that do, it's a really important component. And many innovative companies depend heavily on this R&D to generate future sales. However, from an IFRS perspective, we expense all of the R&D outlays immediately, basically saying that there are no potential benefits related to R&D. However, we know that these benefits must be there. Companies invest in R&D in the hope of getting future sales from this R&D. However, given the uncertainty surrounding R&D, we have to expense it in accordance with IFRS. So this makes it really hard to estimate the performance of these R&D intensive companies. As said, there are some companies for which R&D expenditures are greater than sales, so that would basically say that these companies are doing really bad. But as said, there are expected benefits from R&D, and that's why we want to capitalize some of these R&D expenditures, taking into account that these have future benefits, which would then also allow us to better compare companies that invest in R&D with companies that invest in fixed assets. Fixed assets we can capitalize and depreciate over the years, whereas for R&D, IFRS would tell us to expense everything immediately. So basically what we will do here is we will say that R&D has future benefits. We will capitalize a portion of R&D and then amortize it over the useful life of the R&D investment, which means that there will always be a balance sheet effect because we will start to recognize an R&D asset. Under IFRS, there is no such thing. All of your investments in R&D have to be expensed, so there is no R&D asset showing up on your balance sheet. If we say that we want to capitalize some of these R&D outlays, there will then always be this balance sheet effect in which we recognize this R&D asset. The existence of an earnings effect depends on whether there is growth in our R&D investments, and we will see at the end of the video if R&D investments are stable, basically the annual expenditure is going to be equal to the annual amortization of our R&D asset. Well, let's look at an example where we have Pfizer and they have the following outlays, and the outlays occur evenly over the year. And we want to capitalize these outlays using a 4-year useful life and a 35% tax rate. So whenever it comes to capitalizing R&D outlays, the thing to do would be to draw this timeline. So in this case, we want to capitalize outlays that occur evenly over the year, over the useful life. And in this case, the useful life is 4 years. So if you draw this timeline, this would help you to see which of the outlays are still relevant at a certain point in time. So the point in time that we're now, that's the end of 2012 or the beginning of 2013. And you would see that the 2008 outlay is not relevant anymore. It occurred evenly throughout the year, which is the same as having something in the middle of the year. And given a 4-year useful life assumption, we would see that by mid-2012, the 2008 outlay would be fully amortized. But we also see that the 2009 outlay would still matter for the first half year of 2013. And the 2010 outlay would matter until mid-2014 and so on for the other outlays. And we would also see that the 2013 outlay, of course, would not be relevant for the beginning of 2013 intangible asset. But drawing this timeline can help you to see which of these expenditures are still relevant in the determination of the asset. Because that is step one. In step one, we're going to determine how much should be capitalized. And there are two things that we need to know, and the information was already given in the question. First of all, we need to know when the outlays occur. And in general, that means evenly over the year, which, and that's what you will see here, translates into having one outlay in the middle of the year. And of course, we need to know the useful life, which is in our example 4 years. So the outlays were given. So now let's have a look at how these outlays translate into this intangible asset that we want to have. And let's start with the 2012 asset. So the asset that we want to record at the end of 2012. As we could have seen in the graph as well, the 2013 outlay is not relevant here. The outlay occurs after the end of 2012. So this 6.7 billion from 2013 does not show up in the 2012 asset. If we look at the outlay that we make in 2012 itself, we need to determine how much of that should still be in our asset by the end of 2012. As said, outlays occur evenly over the year, which means that it's the same as having one outlay in the middle of the year. Which means that by the end of the year, by the end of 2012, half a year of amortization should be recognized on the 2012 outlay. We have 4 years, so in each of these years we amortize 25%, 1 over 4, because there is no residual value. So every year our amortization rate is 25%, which is similar to what we've done in the depreciation example. Now, outlays occur evenly over the year, so by the end of 2012 we should have half a year of amortization on the 2012 asset or the 2012 outlay, which means that the proportion of this outlay that should be capitalized by the end of 2012 is 87.5%. 1 minus our annual depreciation rate of 25% divided by 2. And we can do the same for the other outlays. So for 2011, we should have 1.5 years of amortization, such that by the end of 2012, there should be 62.5% as proportion capitalized. And we can do the same for the other years. So in 2010, we should have 2.5 years of amortization. And in 2009, by the end of 2012, there should be 3.5 years of amortization. Which also means that by the end of 2012, the 2008 outlay would have been fully amortized, which is why you see no proportion capitalized anymore there. So for the 2012 asset, the relevant numbers here would be the 2012 outlay, 11 outlay, 10 outlay, and 9 outlay. The 2008 outlay would be fully amortized by the end of 2012. And you see that we can do the same for 2013, but then everything shifts up 1 year, which also means that you can now see the difference between what's included in the asset of 2012 and the asset of 2013. So the 2009 outlay was still included for half a year in the 2012 asset. But by the end of 2013, this would be fully amortized, and the 2009 outlay is not included anymore in the 2013 asset. But other than that, the entire methodology is exactly the same, and you can just shift up everything 1 line. And then you would see that at the end of 2012, we have a 17.15 billion R&D asset. And by the end of 2013, we have a 15.4 billion R&D asset. Which leads to the following adjustments. We have this 17.15 billion asset on our balance sheet, which means we actually start to recognize now this intangible asset. So that's the first adjustment, recognize an intangible asset of 17.15 billion on your balance sheet. Which, as before in the depreciation example, leads to two adjustments. If instead of expensing everything immediately, we recognize a portion, 17.15 billion, as an asset, prior year's expenses would have been lower and prior year's pre-tax earnings would have been higher by the same amount. Because under IFRS, all of this was expensed, but now we recognize 17.15 billion as an asset, which means 17.15 billion was not expensed, which increased our pre-tax earnings by this amount, which will lead to the following adjustments. We will recognize a DTL of, in this case, 35% of that, which is 6 billion, which reflects the fact that these higher pre-tax earnings would also have resulted in higher tax expenses over those years of 6 billion. And in the same way as the depreciation example, we will increase the temporary difference. There is no R&D asset in the textbooks. In the textbooks, there is an R&D asset now under IFRS, so we have this temporary difference that we need to account for. This temporary difference of 17.15 billion, which translates into this $6 billion DTL. And then the remainder would go to retained earnings. If we recognize 17.15 billion as R&D asset, this was not expensed. It would have led to 6 billion in higher tax expenses, but it would then also have led to 11.15 billion higher net profit, which is on our balance sheet reflected in our retained earnings. In step 2 then, we look at the income statement adjustment, which will also help us in determining the correct 2013 ending book value. So what we will determine here is the amortization expense that we would have on our R&D asset during 2013. And for that, you can look at this proportion amortized. And we look at the proportion amortized in 2013. So as said before, the outlays occur evenly over the year, which is the same as having one outlay in the middle of the year, which means that the 2013 outlay should be amortized already for half a year in 2013, which is why you see the proportion amortized as 0.25 over 2. So out of the 6.7 billion that we spent in 2013, 0.84 is already amortized in 2013. The 2012 outlay should be amortized for 25%, the normal annual amortization rate, and the same is true for the 2011 and 2010 outlay. But what you will see again is that for the 2009 outlay, we amortize it for half a year only. Why half a year? Because that's the only portion that was left in the asset by the end of 2012. If you go back to step 1, you would see that the R&D asset at the end of 2012 includes half a year still for 2009. And that is the portion that will now be amortized over 2013. Where you will also see then that if you look at all of the proportions amortized, that should be equal to 1. And then it's half a year in this case in 2013, the first year that's going to be amortized, and it's also half a year of amortization in the last year that's going to be amortized. So if you want to check whether you already reached the stage where you should have half a year of amortization, you can see whether all of your proportions amortized actually end up to 1, because in the end we want to have 1 year of amortization. Now if we do so, we will see that the amortization expense in 2013 is actually 8.47 billion. And we compare that to the actual outlay that we're making. So to see the effect on our profit, we need to compare the amortization of the R&D asset to the yearly outlay. And we see that the outlay in 2013 is 6.7. which we can compare to the amortization of the R&D asset of 8.47, which is a difference of 1.77 billion. And in this case, we would actually see that despite the fact that we're recognizing an R&D asset, the expenses in 2013 would actually be higher. the outlay is 6.7 billion, but the amortization of our R&D asset is 8.47 billion, which means that our pre-tax profit is lower by 1.77 billion, which will decrease our tax expense by 0.62 billion, and on our balance sheet will decrease the DTL by 0.62 billion. And we see the same then for the net income, where net income will decrease by 1.15 billion, and accordingly on our balance sheet we will decrease retained earnings by 1.15 billion. Which we can compare to what the book would do, where you can see that you can go from 2012 to 2013 by following these steps. So what they've done in the book is they directly recognized an R&D asset of 15.4 billion. But you can also arrive at this number by going through the steps from the end of 2012 to the end of 2013. So to arrive at the 15.4 billion, you can actually start with the asset at the end of 2012. And at the end of 2012, we had 17.15 billion in the R&D asset. You would need to add to that the outlay in the year itself, so the outlay in 2013, and subtract from that the amortization in 2013. And you will see that you end up with this 15.4 billion R&D asset. And the same is true for the DTL, where the book would recognize immediately this 5.4 DTL. But you can get to this by going from the end of 2012 to the end of 2013. At the end of 2012, we had a 6 DTL and we took out 0.62 because of the additional amortization expense. And the same is true for the shareholders' equity or retained earnings, where the book would recognize a 10 billion shareholders' equity effect. We arrived at this number from 11.15 at the end of 2012, and then subtracting the effect of net profit during 2013. Now, as said, there is always a balance sheet effect. So whenever we say that we will capitalize R&D, there is a balance sheet effect because we will recognize an R&D asset. But the effect on the income statement depends on whether there is growth in expenditures. And in the example that we've looked at now, there was an income statement effect. Expenditures were different over the years, which means that the outlay and the yearly amortization are going to be different, which means that there is an income statement effect. If we look at the example here, you will see that there is actually no effect on the income statement. Because in the example here, we have an R&D outlay of 8 billion in each of the years. So there are no differences. In each of the years, we have this 8 billion R&D outlay, which means that if you compare the outlay to the proportion amortized and the amortization expense, you will see that there is no difference. Whenever we apply our methodology, you would see that the amortization expense is the same in each of the years, and it's equal to the R&D outlay in each of the years. So as soon as this happens, there is no effect on the income statement anymore. If the outlays are never changing, the amortization will also always be the same, and the amortization will always be the same to the annual outlay. And you don't need to worry about an effect on the income statement. As said, there will be an effect on the balance sheet because we have this R&D asset. But there is no difference on the income statement because the annual expense from the outlay is the same as the annual amortization of the R&D asset.